I'm Foreman, and in this video I'm going to show you 3 UK stocks to buy in June 2021, coming from a person who looks about 13 and is definitely not a financial advisor. Regardless, if you like the video, please drop me one of these to beat that YouTube algorithm, as it is much appreciated. Thank you. The first stock on the list is one I've not mentioned on the channel ever before. I think it's quite an exciting company, although there's certainly some distance that needs to be made and more of a track record that needs to be seen before I would consider buying into it. However, it's certainly one to keep an eye on in the future, as it could be a good opportunity to buy in the more distant future. So however, with this stock, I'd like to bring it to your attention, but not necessarily buy right now, as I personally would not. This stock is in the video gaming industry, ticker symbol TBLD, or named Tiny Build. And they actually develop video games for a variety of platforms such as PC, console, we've also got mobile and handheld consoles like 3DS, and also VR, meaning that they are well diversified between consoles, although they wouldn't exactly be dominating any of those particular types. Their games library exploded, or at least they came to attention with the popularity of their flagship game, Hello Neighbor, which is a stealth horror game about sneaking into your neighbor's house and finding out what dodgy stuff he's up to. So it's quite an interesting story already going there, and it's quite a thrilling game to say the least. Although you can certainly tell that this company has capitalized on the popularity of this game, as there's so many different games in that same universe, all titled like Hello Pigeon or something. It's probably not Hello Pigeon, but there are games much like that, and so you can really tell they've tried to capitalize on it. However, it is quite an iconic style game. It is an indie type of game, and it's not like one of those high AAA budget games that do cost a lot to make. Instead, they found a formula for popularity, and now they're repeating it. Although I feel that that might lead to stagnation, and that in order for this company to grow further, they will need to improvise. Regardless, they do have some interesting metrics. To start, they have a high valuation if you only look at a price to earnings value. They are 55 times on earnings, which is higher than the industry and the market, and is higher than Team 17, a company that has well justified that premium, and one I hold in the same sector due to their top quality management and track record of fantastic growth. The reason why the price to earnings ratio of TBLD is so high is because their earnings are very low. Although this does mean that their price to book ratio, which could be an error, is only 0.1 times, suggesting that they are severely undervalued compared to the assets on their book. However, as I said, they do have very low earnings. In fact, they've only just scraped a profit of a 0.2% profit margin. And in fact, their free cash flow is currently negative. However, and this was quite a groundbreaking year in 2020, in which a lot of people had spent their time playing video games as they couldn't leave the house due to lockdowns, for instance, and so this may become more of a negative trend in the future. Hence why I would like to zoom out in time a bit, give it a few years and see how it is. But there's no doubt that buying now could be an opportunity should they justify the need for that high valuation or continue to grow their earnings at a fast pace. What we have seen in this time, and that's since 2018, is that they've managed to over triple their revenue, which is very impressive. It would be nice if their profit margins would follow alongside that, although they could be reinvesting a high proportion of their earnings before declaring it back into the business to fuel further growth. They have a fantastic balance sheet, and actually a common trend is on this video, all of the companies I'm going to mention will have fantastic balance sheets. For instance, their short-term assets outweigh their short-term liabilities and long-term liabilities. They have absolutely zero debt and over $4 million of cash on the balance sheet, which means they do have the capital available to keep surviving, especially because they are currently not unprofitable. But even based on a negative cash flow moment of around $988,000, they could continue surviving for 4 years if that equaled unprofitability. So there's a lot of room for stability and defensiveness in this stock, and it really depends on how well they can grow in the future. Although the question of their market capitalization could be more of a concern. And this is where we look at the competitors in the industry, and we see the likes of Sumo Group, a game that is only slightly higher valued at around about £650 million compared to around £500 million of TBLD. However, we can see that Sumo Group has a far better games catalogue, likely due to the fact that they were licensed out to make these big AAA games, but still, I would certainly side with Sumo for the catalogue. and for many other reasons. And so at the moment, at least until they develop a track record of where we can see how well they're able to grow, they could be a much more speculative investment. And this is also considering that they recently IPO'd in March. And I personally wouldn't buy a stock straight after IPO. I like to give it quite a period of time before considering it. I'll keep it in my line of sight, but I won't, for instance, buy in. I'd like to see at least 6 to 12, maybe even like 18 months of just a track record, then being listed on the markets to see how the valuations and how the market would value it before dipping my toes in, to say. However, at the moment, industry valuations are high, especially in the video gaming sector due to the recent buyout of Codemasters by EA. So a lot of them are currently trading at a higher premium than usual, and so this could be a further risk in general. Whilst this is probably not a stock to buy in June 2021, I do hope it is one you add to your watch list, as there is potentially a lot of potential for the future with this company, especially if they figure out and crack that formula of what they found using Hello Neighbor and develop future games that are able to really capitalize on that. If you didn't already know, I have a Patreon. If you're interested in signing up and seeing the benefits, then click the link at the top of the description down below. The next stock is a competition operator in the UK that prizes or has weekly prizes of luxury cars online, such as sports cars. Need I go on? They've even recently created a mobile app, suggesting that they've now gotten to a different type of consumer base. And this app does have some good popularity. This stock ticker is BOTB, or best of the best. Honestly, right now, this is a stock that I would add to my Freetrade portfolio. But there's a catch, and the reason why I can't add it to my Freetrade portfolio is because Freetrade don't actually have the stock available, so I can't buy it. And I'll explain the reasons as to why I would buy this stock right now. Firstly, their valuation is low. Whilst they've got a price to earnings ratio of 31 times, which is higher than the general UK market of 25 times, this isn't considering where they could be in the future, and instead is looking back 12 months as price to earnings ratios do. Their growth in the last year has been fantastic, to say the least, and so this could continue, even albeit at a slower pace, and would mean that that price to earnings ratio in the future would be far lower, as they have very strong growth and minimal factors that will push the price down or decrease the margins over time, and so there is a lot of potential. This is because in the past 5 years, they've managed to grow their earnings by a compound annual growth rate of 38.1% each year. At the same time, revenue has grown by even more. What it does show is that with revenue growth, earnings scale with it, suggesting that not only are their margins increasing over time, but this could become a much more profitable company as that revenue increases. Especially when we look at the effectiveness of, for instance, their returns on equity, which is 118%, or returns on capital employed of 142.4%. I guarantee there are not many companies with phenomenal stats just like that. And that's due to the natural cash generation of the business and how they're able to generate seriously high amounts of cash. For instance, and this was a Twitter thread, and so it could be speculation or it could be false, and I'm unsure as to whether I'll be able to find it, but I will look and see if I can add it to the video. This Twitter thread suggested that if they were to use Facebook advertising, which they may already do, it would only take them 2 months to make their money back on the adverts, suggesting that when someone is on Facebook, they click the advert, they sign up, that cost of the advert is paid, and then it would only take 2 months of regular entering into the competition for that advert to completely have paid it off themselves. And then they go further to suggest that customers usually stay a lot longer than 2 months and end up repeat customers, meaning that that cash is going to continue increasing, and then they can reinvest that back into grow more adverts, and that will, for instance, exponentially scale. So there's a lot of promise with this already. Once more, a very, very high quality balance sheet with their short-term assets completely outweighing their short-term liabilities and long-term liabilities, simply because there are no long-term liabilities. This means they have absolutely zero debt and plenty of cash on the balance sheet with £11 million, which outweighs their total equity. This is also a dividend-paying company with a yield of 1.63%. However, what is really promising about this is their low payout ratio. When someone says a low payout ratio, you may be thinking, okay, maybe it's about 30 to 40%. Well, in BOTB, it's 4%. So if their revenue and earnings continue to grow at a similar rate to last year, which was perhaps a one-off year, so let's just even half that, even if they grow their dividend by a significant amount, that payout ratio is still likely to decrease, meaning that they're either going to grow that dividend massively in the future, or it's just going to keep decreasing in payout ratio and they can reinvest even more of their earnings back into the growth of the business. They've also got management with some skin in the game, which is always a very promising sign to see as well. However, the biggest downside of this investment is its lack of widespread availability on stockbrokers due to being a small cap of only £200 million, and also the lack of liquidity, which means that they do have a fairly savage spread. This spread is equivalent to 10%, meaning that when you purchase this stock, 10% is already gone because of the difference between the buy and the sell price. However, this stock has dropped over 30% from all-time highs, likely due to the growth stock pullback in the US, and so there is promise with it, and you would be getting a fairly good value in my personal opinion. If you'd like a free share worth up to £200, then sign up to Freetrade using my link in the description down below. Another stock on the list is a commodity miner focusing on platinum group metals such as platinum, rhodium and palladium in South Africa and Mauritius, which is East Africa, although I've absolutely butchered the name of that place, no doubt, as I didn't know of it prior to this video. They dropped recently, and when I say recently, the day of recording, by around 10% due to drops in rhodium prices, which obviously are going to impact the future expected revenues of this mining company. The stock ticker is SLP, named Sylvania Platinum. This stock is very undervalued on a price to earnings ratio of 8.6 times, which is lower than the industry and much lower than the market, suggesting that should their valuations become more of a premium, perhaps known for their higher quality, or because platinum group metals become a much more used and more scarce material in the future, then this could definitely justify a much higher premium. Although with the likes of mining, you've got the ethical concerns as they do destroy the environment, and that's no different in the case of platinum. And so there is always that concern that will likely keep the valuations that bit lower compared to other stocks that are, for instance, more ethical friendly. However, in the last 5 years, they've had very impressive earnings growth with a compound annual growth rate of 52.9% each year. And that's despite, during this 5-year period, platinum as a price, I've not looked at rhodium or palladium, has remained relatively stagnant and trading sideways, except for the last year in which it recovered from the 2018 prices, which suggests to me that they're not making more money because the price of the PGM or platinum group metals are increasing, but rather because they are becoming a much more profitable business and they are organically growing, although I could be wrong. And that's because I lack understanding in the mining industry. This is why I wouldn't buy a stock like this for myself unless for diversification if I felt it necessary, because I don't understand it, and so it would only be protection against ignorance, but I'll talk more about that in a bit. Once more, a brilliant balance sheet with their short-term assets outweighing their short-term liabilities and long-term liabilities combined. They have absolutely zero debt, definitely a trend here, and the likes of a cash position of $67 million. This is also a dividend-paying company with a yield of 1.1%, once more with a fantastically low payout ratio of only 10%, suggesting that if the likes of PGMs continue to rise in price, the company becomes more profitable, then this payout ratio is very low and they could definitely increase this dividend yield right up should they choose to do so. Meaning that in the future they would have a lot more sustainable growth and they wouldn't have to impact their payout ratio that much. Especially if we consider the potential of the commodities in the future. At the moment, PGMs or platinum group metals are used in catalytic converters in car engines or other types of engines, and these reduce the NO2 or nitrogen dioxide, I believe. I've not done chemistry in a long time, and basically convert that into more friendly for the environment chemicals. This is also quite a valuable piece of kit, as 85% of these are usually made by PGMs, and that's why you see or can hear about quite frequent car thefts, or not even car thefts, of people stealing catalytic converters from certain cars in the UK. Whilst the likes of electric vehicles could pose a big threat to the PGMs, In the future, we have got an increase of hybrid vehicles that combined both the petroleum-based engine with an electrical vehicle, and so they still need these catalytic converters. I don't know the distant long-term aspects of PGMs because this is something I really don't understand, but if you are bullish on these core types of metal and you see a good use case for the future, then I think Sylvania Platinum could be a great way to gain exposure into this commodity, especially because they are relatively undervalued and they are a very profitable company. That doesn't mean you're just buying the commodity itself. And that's why I feel that if I wanted to protect myself from ignorance and I felt that platinum, rhodium or palladium is going to do well in the future, then this would certainly be a buy in my portfolio. If you're interested in my views on Argo blockchain and when to buy or sell the crash, then click the card at the top right of the video. Thank you for watching. I'm Foreman. Have a great evening.